some of the things that we're watching, firstly, developments in trade and manufacturing. I mean, the slowdown that we've seen in the global economy over the last 12 months has been largely driven by slowdown in manufacturing related to the trade war in particular. So while we're watching that closely, I think probably the more important thing is whether that spills over then into the service parts of the key economies. We haven't seen it much yet, but I think it's just starting to appear. You are seeing, sentiment in the service sectors starting to roll over a little. You're starting to see some job losses in those areas, and that's probably the key risk actually, is that, because services employ so many more people than manufacturing does in developed economies, to the extent that we start to see the broadening, if you like, of that concern into services, that's probably the big sort of downside risk for growth from here. Another thing we're watching is earnings. We think that probably markets are too optimistic about earnings expectations for companies, particularly in the US. On our sort of top-down modelling, given the macro view of the world, we think there's a risk that earnings over the next 12 months could print negatively. That contrasts to sort of small upwards profile that most analysts have in place. So we think that's a risk, and of course, if earnings do print negatively, then equities come under pressure, and probably credit spreads come under widening pressure. It's not great for risk assets. And then finally, I guess like most people, we're monitoring the probabilities for US recession pretty closely, and we do this in a number of ways. We've got a number of different tools that we use. Probably our most detailed tool still actually telling us that recession is some time away, more like 12 to 18 months away rather than being imminent. But the probability of that event occurring in that time frame is pretty elevated. So it's something we're certainly concerned about and watching closely. And I think this question about whether we get the spillover from manufacturing into services is pretty critical. If we do get that, then you probably see that time frame pulled forward. It's probable that the US tips into recession earlier if we do get that spillover. And what does that mean? It means instability, I guess, for equities. Credit comes under pressure, default probabilities increase. More easing by central banks as well, hopefully to stem some of that.